raises rates too high, too much initially and too quickly, I think it makes the markets concerned that the Fed is seeing something that the marketplace doesn't understand or doesn't see. So I think that they're both important. We do expect the Fed to raise rates. They have to. It's too much of a political issue not to, but we don't think that the rates are going to be more than the market can bear. So we do think that rates stay relatively supportive for the equity markets going forward, but there's no doubt that the Fed has to raise. There's no question.
Terry, can I push you on that a little bit more? When you say things like it can't be more than the market can bear, what does that actually mean? And isn't the objective to get tighter financial conditions?
Well, it certainly is to get tighter financial conditions, but it's also a question of how they do it. It's a question of, do they raise rates? Do they start to sell assets on the balance sheets? We're starting to get a lot of different information from the Fed in that there's not a lot of control on the narrative. And in their defense, they're working off models that have never been working through a situation where we have zero interest rates, a geopolitical situation, and a 7% print on inflation. So it's just a very difficult environment for them to read as well. But I think that the market can bear certainly the 3 to 5 interest rate hikes that is being priced into the market for now. It'll still be accommodative for the market.
Jim Bianco, your take, please.
Yeah, I think what Wall Street is generally having a very difficult time getting their head around is, what is the Fed's priority? Everybody assumes the Fed's priority is growth. Everybody frames the discussion about growth. Well, what's this mean for growth if the Fed is going to raise rates? I think the priority has been shifting to inflation. We should be asking, when is inflation going to be down low enough that they could stop raising rates? And unfortunately, a lot of people think that that's not till next year. And that's why I think that we dismiss this idea that they're going to raise rates 6 or 7 times. That's what the market is priced in, because we think about growth. But if we think about inflation and we go, if their priority is inflation, then they very well might have to raise 6 or 7 times. And if that means growth has to take a hit, because that's the objective, and asset markets are going to have some turbulence because of it, then so be it. That's the environment we're in right now. This is what happens when the Fed stays at 0 all the way to 7%. They don't have a thread the needle option. They've only got trade-offs. And right now, I think the trade-off they're going to pick is more about inflation and less about growth.
Greg, if that's the case, let's talk about market implications. Michael Hartnett of Bank of America put out this morning. The percentage of stocks in a bear market, 76% of the NASDAQ, 51% of the S&P 500. He went on to say the Fed is tightening into a crash and stagflation. Credit stock bear markets beginning. Now, it's pretty inflammatory stuff when you think about it, Greg. Beneath the surface, though, there's been some destruction in the equity market, some real destruction. I wonder, from your perspective, your view, Greg, when you look into the credit market, the degree of destruction you've seen.
Yeah, so I think directionally that's right, but I would push back on destruction. I think there's been very little, and I agree 100% with Jim's comments. I think the narrative is inflation, and let's be clear, that's a new narrative for most investors, right? That hasn't been part of the calculus since the late 70s, early 80s. So this focus on financial conditions seems like a sideshow to me. So I don't think there's been much movement at all. So if you look at credit spreads, so just, the IG corporate market in the U.S., we're coming off the global financial crisis tights at 80 basis points. It widened to 120, but it's still tighter than where COVID started. So to me, value hasn't been created. I think investors are too quick to jump on, it's cheap enough, 10% or whatever the number is, after it's rallied 200% or so. So to me, it's too much near-termism,
So give me a call,
and
Greg.
I think it's missing.
Tell me what
the
you're
big
doing.
picture.
What are you doing right now?
So there's good news, bad news story. The bad news is that I do think the beta in the market, that valuations still have a way to go, but the dislocations are really becoming quite pronounced. And so what we're doing is relative value. And I know that sounds like a cheap phrase, but right, you look at the unevenness of the moves, Europe versus the U.S. in high yield, for example, even within emerging markets, should a LATAM traded off as much as it did. So we're really evaluating those relationships. But definitely not diving into the pool here. I think this is a volatile time, and we haven't really seen the repricing yet.
It's a delicate time, and I appreciate the time of all three of you. Thanks for being with us. Greg Peters, to Terry Jacobson, come back soon, please. And Jim Bianco of Bianco Research. Let's talk about where we are in the market, in the equity market at the moment. About 10 minutes into the session, the S&P 500 looks like this, up 0.6%, turning a little bit lower on the NASDAQ by 0.1%. Just listen to the description of what's happening in Ukraine right now. This from AP. Russian troops bearing down on Ukraine's capital with gunfire and explosions resonating ever closer to the government quarter. That's the reality on the ground in Ukraine at the moment. The reality for sanctions, well, there's a carve-out for energy, isn't there? Take a listen to this.
To be clear, our sanctions are not designed to cause any disruption to the current flow of energy from Russia to the world.
You'll hear from the administration next.
We're not going to do anything which causes an unintended disruption to the flow of energy as the global economic recovery is still underway.
The goals of the administration to carve out energy. We'll get to that in just a moment. Some headlines I want to get to as well. Few things happening simultaneously here. Some comments from the Russian President Vladimir Putin accusing Ukraine of using civilians as cover. At the same time, we're hearing from the Chinese that state banks are restricting financing for Russian commodities. You can see the spillover there. We'll touch on that in just a moment. There is an ongoing news conference as well that involves European finance ministers and President Lagarde of the ECB. This is what Lagarde's got to say at the moment. The ECB to do what's needed for price and financial stability. I think this is key, though, too. Too early to discuss the economic impact of the invasion. That's where the ECB's at. It's where arguably the Federal Reserve is at as well. It's too early. It'll take its time and we'll see. On the energy side of the story, we've seen the sanctions come through. And the administration is almost saying the quiet bit out loud now. There's a carve out for energy because they don't want to disrupt energy flows. I want to turn to Anne-Marie down in Washington, D.C. to catch up with a voice from this administration. Anne-Marie, good morning.
Good morning, John. That's right. It's part of the industry that's incredibly important to Putin, his economy, but it's come out of the sanctions package absolutely, relatively unscathed. And I'm joined here to discuss this and why that is with Amos Hochstein. He's the global envoy for energy security for the administration. Thanks, Amos, for joining us at such a difficult time right now.
It's good to be here, Anne-Marie.
So we heard from Dalip saying energy is not going to be targeted. What is it going to take? What does Vladimir Putin need to do? Troops are surrounding Kiev for the administration to hit him where it's going to hurt the hardest.
Well, I think we are hitting him where it hurts the hardest because the goal for sanctions to make them as effective and as successful as possible is basically two elements. One is to make it as global and multilateral as possible, and the second is to make sure that you're hitting the target, in this case Putin, harder than and mitigating the risk for ourselves, the American economy, and the global economy. And I think that's what we did here.
Sanctions may act as a punishment, but it's clear that they have failed, still failing at this moment, as a deterrent. What kind of deterrent is the U.S. ready to potentially put on the table?
Well, I think that it's a bit too early to say what has succeeded and what has failed. This is not about a deterrence. This is about the fact that we're sending a message. If you invaded Ukraine, which he has now done, launching missiles into cities for no reason whatsoever, and punishing the entire population of Ukraine, and committing this kind of war in Europe for the first time since World War II, that there's going to be consequences for this. I think it's a bit early to say if sanctions have failed or succeeded when it's been barely 24 hours.
But they did fail in the sense that we've been here before with Putin many a times, 2014 most recently, and he's still making inroads into Ukraine. But on oil and gas, the United States has no problem sanctioning Venezuela, oil and gas, no problem taking Iranian barrels off the market. When can we ever potentially see Russia seriously on the table?
Well, I think that the goal of the sanctions is to hit Putin as hard as possible while mitigating the effect on the U.S. economy and Europe. And I think that comparing this to 2014, and as you know, I was in the administration in 2014 when we imposed the sanctions. We have a lot of members of our team that were there in 2014. We have a lot of experience in what worked, what did not. These sanctions are significantly harder and harsher and more international and multilateral on Putin than we've ever done before. Definitely more aggressive than 2014. But at the end of the day, Anne-Marie, if we target the oil and gas sector for Putin and the Russia's, in this case, the Russian energy establishment, then prices would spike. Perhaps he would sell only half of his product, but for double the price. That means he would not suffer the consequences, while the United States and our allies would suffer the consequences. That is not a win. That is a fail. What we are doing here is going after the largest banks, and even though there is a mechanism here to allow for continued energy transactions, it's going to be harder and messier. It's going to be difficult to transact with Russia on a broad basis. They need to raise money to continue their additional investments into oil and gas for their future growth. They have their natural declines anyway. So we are trying not to affect today's global oil and gas, but this will clearly have impacts for the future of Putin's energy
and that's fair.
Complex.
VTB and Sberbank are massive. I don't know if the U.S. audience quite understands how big these banks are. When it comes to the natural gas story, if Putin starts to play politics with natural gas, which he did a little bit last year, where are we in terms of flows or potential tankers from Qatar that were supposed to go to Japan but actually diverting themselves to Europe? Is that still in the works? So
first, yes. And what we've been able to do over the last few months is we identified what Putin was doing in targeting European energy security already 5-6 months ago. He cut supplies down to contractual levels only. He reduced his supplies through the pipeline from Ukraine Ukraine, but also through other
But today,
pipelines.
even on the Ukrainian grid, up 35% as opposed to yesterday.
Yes, so we are still seeing flows, and we'll take as much flows as possible from Russia. We want to make sure what we've been able to do as the United States is, as you said, we had a global campaign working together with our allies in Europe as well as Asia and other producers to divert cargoes that were intended for Asia to go to Europe. That has enabled, thwarted what Putin was really trying to do, which was to time the invasion with rolling blackouts or economic distress in Europe. That was not achieved. We were able to thwart that, and there's enough natural gas supplies to get through the winter. We now have to make sure that there is enough for the spring and into the summer.
Just finally, I want to end on, you were recently in Saudi Arabia. What is your message to the kingdom in the sense, or what did you receive in terms of, are they going to be able to help quell the price of oil prices? Is Saudi Arabia going to be able to put barrels on the market?
Well, look, we're trying to message three basic things. Today, as of today, there is no disruption in oil supply through Ukraine as a result of this war. Number two, the sanctions will not target the oil flows as we go forward. And number three, that the international community, producer and consumer, are prepared to take action. We have prepared for this moment.
But prices are still elevated.
Prices are elevated, and Marie, they were at 108 or 9 yesterday. They're down again today. We've brought the prices down to 98. I think the prices, now that the market will absorb that the risk factor in the market is lower, we can see prices go down from here. I can tell you we are very well coordinated with both producers in the Middle East as well as with consumers around the world.
Amos Hochstein, thank you so much. John, that was the Global Special Envoy for Energy Security, Amos Hochstein. I think the message from the administration is they want to be able to hit the Russian economy, but at the same time, make sure it's not impacting U.S. consumers.
A really important voice from the State Department, AMH down in D.C. Thank you. Let's get to Henrietta Trays of Vader Partners. Henrietta, putting sanctions together is really difficult. I don't want to undermine the difficulty that goes into all of this and the amount of work that goes into it for the Europeans, for the administration. But can we, for a moment, just put ourselves in the shoes, if we can, of the Ukrainians? When they hear stuff like this, that gas volumes through Ukraine are up and it's a good thing, when they hear the Italians pushed out to carve out luxury goods from the sanctions, that the Belgians pushed to carve out diamonds from the sanctions. I mean, Henry, can you imagine what they'd be thinking right now if they heard this conversation?
It's certainly not indicating at all that the United States is going to somehow stop this. I mean, we can't have a conversation in the Senate about sending arms anymore. You're going to get an aid package that right now is only, the whisper number is about $10 billion. And they won't pass it for another week and a half, and who knows where the Russian invasion will have landed by then. So I would not say that there's a lot to be thrilled about from the Ukrainian perspective, but I do think that the Energy Secretary, as we were speaking to him before, y'all were speaking with the director there, it's interesting to see that the United States is taking a target directly at President Putin. And I think that is a longer term strategy that the Ukraine can take heart in. Certainly Eastern European NATO nations can take heart in. This has got a longer term time horizon than just stopping this immediate incursion, specifically with the export control restrictions, which I think are designed expressly to curb Russian advancement on all kinds of emerging technologies, military capabilities, business allowances, certainly the financial sector. This is long-term harm to Russia, which I think is what President Biden made clear yesterday and what they're generally after. So for the Ukraine, it's not great, but for Russia as a whole, it is definitely holistic.
Hurting them is one thing. Influencing and shaping behavior is quite another. Henrietta, do you think targeting Putin directly, targeting the network of oligarchs around him, do you think that could be effective in changing the behavior of the Russian government?
I absolutely do, and I think that the Biden administration and folks who are working on the sanctions team, as you just heard, are incredibly adept and have a lot of tools in their toolbox that they have negotiated and worked out for many, many years now. And I think, frankly, the trade war with China was very instrumental in getting them a really finely honed coordination between the Bureau of Industry and Security, the export control restrictions, CFIUS, the Pentagon, the State Department. They can work together in a way that I think will target not just one piece. So it's not just Putin and oligarchs and the elite in the nation, but the entire financial sector, 80% of the financial sector, their future of all kinds of AI, quantum computing, all of those advanced or emerging industries, 24 different sectors. That's what they're targeting. I think that really is a robust package that will continue to get more difficult for Putin to sustain or withstand, and his elites as well, which is what the United States target is. I think it's a pretty responsible and comprehensive package.
Henrietta, just a final topic for us both, the importance of China. That's something we followed all through this morning. There was that state media report that the two leaders spoke to each other this morning, President Xi, President Putin. Then the headline came from Interfax that they wanted talks. Henrietta, I'd like your assessment, the chances of those talks happening, one, and two, the importance of China in this conversation at the moment, too.
I think China is top of mind for a lot of investors right now. The inbounds I have from clients about what this translates to for commodities, what it translates to for Taiwan is extensive. And I think that China plays a gigantic role here, particularly in how much of the commodities they're prepared to purchase. They're making some small moves today to try to, I think express some global condemnation of the Ukraine invasion, but it's a very sensitive component. And I do think that the United States actions with NATO over the last, month and a half have been very indicative of a growing global coordination between the EU, the UK, Japan, the United States, Australia, that is designed to ultimately target China. And if Russia is involved in that package, then so be it.
Henrietta,
I do think this is the focus.
Thank you, as always. Let's catch up soon. Henrietta Trace there of Veda Partners on a really important conversation. How do you do this? It's threading a needle. You heard from the official from the State Department there, this line. Hit him as hard as possible whilst mitigating the impact on Europe. Can you hit them that hard if the goal is to mitigate the impact on Europe? Here's your trading diary. What to look for. Get some data at the top of the hour. Don't miss that. US market manufacturing data coming up on Monday. Fed speak throughout the whole of next week, including Raphael Bostic, followed by Chicago Fed President Charles Evans on Wednesday. Finally, already here, next Friday, the payrolls report from New York City for our audience worldwide. Thank you for choosing Bloomberg. This was the Countdown to the Open. This is Bloomberg TV.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day this Friday, February 25th. Here are the top market stories we are following for you at this hour. Talking about talks, Russia is reportedly open to talks with Ukraine, but Sergei Lavrov says that's on the condition of surrender. The EU, meanwhile, gets set to freeze Lavrov and Putin's assets as the invasion presses on. Commodities in the crosshairs. War hasn't stopped oil and gas from flowing, but the grains trade faces disruptions. Higher prices and higher freight rates fueling concerns about inflation and the central bank response. Looking through it, risk sentiment tries to push through price pressures and geopolitics. U.S. stocks are mixed after Thursday's ferocious rebound, and Europe is playing catch-up. From New York, I'm Kaylee Lyons with Tom McKenzie in London today. Alex Steele and Guy Johnson are off. Welcome to Bloomberg Markets. Tom, happy Friday. It has been quite a week that will go down in history, and it's still not over.
It is still not over. We've had some comments from lawmakers that we've been keeping across. Of course, we've heard from the ECB president. We'll get to those lines shortly. But the data is breaking as well. We had some solid data just in the last few hours, just to shift the focus away, just momentarily from the geopolitics. Though, of course, there is the overlap when it comes to the inflationary impacts, as you touched on there. But we have the Michigan survey, consumer sentiment survey for the month of February, coming in at 62.8. That's a solid beat. The previous number was 61.7. So 62.8 from that Michigan sentiment survey, just building on the data that we had out over the last few hours, suggesting that personal income, personal spending came in higher than expected, and durable goods also a beat, Kaylee.
Well, and a lot of economic data this morning and this afternoon, I guess, for you, Tom, and that includes housing data crossing now as well. It coming in much softer than expected. When you look at pending home sales for the month of January, they fell 9.1% from the previous year, falling 5.7% on the month measure, which was actually expected to be up by about 0.2%. So a little bit of softness starting to come through in the housing market, which in the U.S. has been persistently quite strong. And I wonder how much the impact of higher mortgage rates has a little something to do with that, Tom.
That is certainly a discussion point here in the UK, where the Bank of England has hiked twice and is considering, of course, hiking a third term. That's felt very quickly indeed in the mortgage market here in the UK. OK, let's get back to the geopolitics then and the invasion of Ukraine by Russia. Day 2 of that invasion. There's a report that Vladimir Putin is open to talks. Bloomberg's Henry Mayer, who is in Moscow, kicks off our coverage. Henry, what do we know about these proposed talks?
So they emerged today, the offer of talks emerged today with Dmitry Peskov, President Putin's spokesman, confirmed that Russia is ready to discuss the neutrality of Ukraine. This came after some comments made by President Zelensky of Ukraine early in the day, in which he said that he wouldn't be afraid to discuss this. So this is the first kind of indication of any kind of diplomatic effort. But I would say that, you know, the Russians have made it abundantly clear that what they are willing to discuss is the surrender, essentially, of Zelensky's government and of Ukraine. So, you know, it's unclear what response will be in Kiev to that.
All right, well, we will wait for the developments and know you will keep us apprised of them. Thank you so much to Bloomberg's Henry Mayer in Moscow. Meanwhile, the European Union is coming out with its own package of sanctions on Russia. Bloomberg's Maria Tadeo is in Brussels with that story. And Maria, we understand the EU now getting ready to freeze the assets of both Putin and Lavrov.
Yes, Kaylee, and this is, of course, an ongoing situation. We're actually waiting for official confirmation, but sources now telling us that both Vladimir Putin and Sergei Lavrov would be included in this package. Now, a lot of this, Kaylee, in reality, you have to look at the real damage that will do, but also the symbolic nature of it. We know that in terms of the actual damage that it does, well, for Vladimir Putin, it's very difficult to figure out how many assets he actually owns and what kind of money he has. When you look at what Vladimir Putin officially says, he owns his 3 cars and an apartment. That is it. When you look at Lavrov, well, maybe that you could get to a little bit more, but ultimately he'll tell you these sanctions are unfair and they're baseless. But I guess the point about this is to send a message that the European Union is willing to go after everyone in the Russian government, from the president to his very close senior advisors and the very wealthy group of people that have surrounded Kremlin politics for years. Again, whether this serves to de-escalate the situation. I would say it's probably reading too much into this. This is a move that has a symbolic nature, but we know on the ground what Ukraine says it needs is cash, financial help, and weapons quickly if they want to defend Kyiv. And we know, by the way, that there has been very heavy fighting over the past 24 hours around the Ukrainian capital.
Brussels correspondent Maria Tadeo with the latest on the symbolism of those plans to cut off Vladimir Putin and sanction the president personally. So what does the Biden administration do next? Let's go to Bloomberg's Anne-Marie Hordern, who is at the State Department. Anne-Marie, what are we hearing?
Well, we had the sanctions package yesterday from the administration, and it goes pretty much very heavy on the financials of Russia. Sberbank, recently rebranded Sber, and VTB are two massive Russian financial institutions. And already we hear from the Russian Central Bank talking about the fact that they don't want banks to give out dividends or manager payments because they want to see how this all plays out. So they are hitting the stability of the financial sector, but obviously one area of the Russian economy, which is the lifeblood of the Russian economy, and it's why President Putin is able to have more than $600 billion in reserves, is the oil and gas market. And that has come out unscathed. And I just spoke to the special envoy for global energy security, and he said that if they were to put sanctions on Russian oil and gas, that would mean you are taking supply off the market and a massive price hike. Now, that math definitely makes sense to me. And what he said was what that would do is that President Putin would still be able to sell some of that, probably illegally, but still be able to sell some of that, maybe half, at double the price. So Putin and the Russian economy would still be living off those funds from the oil and gas sector, but everyday Europeans and Americans, they'd be the ones to suffer.
Well, and meanwhile, the White House, while it is focused on geopolitics, is also focusing on the empty seat that will be vacant on the Supreme Court. And we now have gotten confirmation that President Biden has nominated Judge Ketanji Brown Jackson to the Supreme Court. Of course, this would be a history-making judge, if confirmed, being the first black woman to sit on the high court here in the U.S. That was reported earlier, but we, of course, now have the White House confirming it. Tom, of course, this is the high court. This obviously has serious judicial consequence, but cultural as well, and President Biden fulfilling a promise here to nominate a black woman to the court.
Yeah, not changing the weighting, of course, in terms of the conservative nature of the Supreme Court, but in terms of the approval process, the nomination process, we now know, of course, she's been nominated, then she has to get through the Senate, but the fact that she is already a judge, a court judge, who's gone through part of that vetting process means that maybe that will be sped up, and possibly April is the time frame they are looking at to start that process. So the importance, of course, absolutely, of the domestic politics in the US, the symbolism, even if it doesn't change the conservative nature, of course, of that Supreme Court.
All right, so one eye on the domestic politics, the other eye on foreign politics. And we'll talk about the market implications of the current geopolitical situation and how you can hedge your bets in the middle of a crisis like this. We'll be discussing that with Manish Deshpande, Barclays head of equity derivative strategy, next. This is Bloomberg.
is to maintain the pricing.
Tuesday night, March 1st.
We are ready to respond decisively.
Bloomberg brings you live coverage of the State of the Union address.
America is back to work.
Hosted by Joe Matthew.
Inflation is kind of the #1 talking point so far.
Reaction, analysis, and what it means for Wall Street.
He did leave this door open. Those are the words Democrats wanted to hear.
Biden may get a little bit of a lift on this.
The State of the Union address, followed by the Republican response. Coverage begins Tuesday night at 8:30 Eastern.
Welcome back. An indicator from Citigroup is signaling it is time to buy the dip. A note out today says that only 7 of the 18 potential red flags in Citi's bear market checklist are waving. Meanwhile, our next guest has looked at cost-effective ways to hedge geopolitical risk. Let's bring in Manish Deshpande, then Barclays Head of Equity Derivatives Strategy. Manish, thank you for joining us this morning. I want to start with what we're seeing in the European markets before we get on to the options around hedging. We're seeing gains of 2.8% in the benchmark today, making up for some of the losses that we saw yesterday. Is there complacency in these markets? Goldman Sachs, Bank of America reducing their targets. Does that sound rational to you at this point?
So yes, I do think that there are clearly still risks ahead, and if things escalate from here, European equities would be more vulnerable from this point. And it is actually remarkable that year to date, or even month to date, when the Russia tensions sort of really escalated, especially European equity markets, have not suffered more. So I think there is a bit of complacency here. Obviously, it all depends on what further sanctions are put in and what market assesses the effect of those sanctions are going to be. But right now, we do think that from a tail risk perspective, buying options on European equities would be the most cost-effective way of hedging.
Where else is it still cheap to hedge, Manish?
So across the board, of course, there is option volatilities have gone up. So I think one way to cheapen the hedges is to say, you don't just buy outright options, but you also sell some downside options where it has become more expensive. So the interesting thing about European equities is that very downside options have become very expensive. So what we are saying is that, let's say you buy options with put spreads with a range of 10%, which is probably the pain that you would get, if things really get worse, and not more than that. So that is how you're cheapening the hedge, by actually selling the out of the money options. The other trade that we also like is also still buying U.S. options on the oil ETF or oil in general, so call spreads in this case. And there is a similar dynamic there too, that very out of the money options are actually become much more expensive.
Is that the ultimate inflation trade then? What are the other options around hedging for these inflationary shocks that we're seeing across the system?
I think that is the cleanest way because, as we know, of course, you can get very local and look at things like natural gas products in Europe itself. But as far as sort of a simpler thing, that is clearly the one which is the most compelling. The other alternative would have been something like gold, but that isn't set up as a clean hedge as oil is concerned.
Manish, I'm wondering about retail traders in this environment, given the uncertainties that are out there on the monetary policy front, the idea that liquidity is going to be much less abundant on the geopolitical front, a lot of question marks there. If the retail trader isn't as active, isn't driving the volume of bullish call options we had seen them driving previously, how does that influence the market, that activity, or lack of it?
So it has been interesting, and of course you need to distinguish between different kinds of retail, retail investors who hedge through, their ETFs and mutual funds versus retail traders who invest directly in single stocks. But broadly speaking, what we have seen, as I'm sure you know, that year to date, actually, the flows into mutual funds and ETFs in particular actually has remained quite strong. So that has been a bit puzzling that despite, all the angst around what the Fed was expected to do or still expected to do, and then on top of this Russia, flows actually have not really slowed. So there is continuing inflows. And typically, of course, that's sort of a bit of a contra indicator. So that is the worry that if, these uncertainties persist, you could see outflows from that channel, which could pressure the market further.
Manish, is there a case to be made for getting more global exposure at this point? I'm thinking of the likes of Mark Mobius, the emerging markets investor. He came on and said to us that, look, China is something of a safe haven at this point, given particularly that the monetary policy support is coming through from the PBOC. Is that a region that looks attractive?
I would, I guess, respectfully disagree on that front. So actually, we are a little bit worried about China. And I think the one way to think about this is that perhaps there is a floor, perhaps don't get too much downside there. But the support that the policymakers are doing there, PBOC and broader fiscal measures and so forth, are likely to be just enough to stabilize it. So if you look back just as a quick, so there have been 3 times when China has actually reflated at sort of when the credit growth drops. And the first 2 times, they did it very quickly and they did a massive reflation shock and all kind of reflation. In 2018, they did enough to just support and not sort of crush growth. And we think it is going to be a similar measure. So enough to not cause further downside, but not enough to cause a massive upside from here. So I think, but there is a floor here, especially given, what is going to happen from the political side for the rest of the year and also where we are in terms of credit growth. So there should be support, but we don't think it's a massive upside kind of scenario.
So Manish, do your worries about China extend to the broader emerging market complex?
No, I think the other emerging market complex is a little bit quite different, right? There's a lot of idiosyncratic things going on in Brazil and the rest of the emerging markets. I think the only thing that our fixed income colleagues worry about is, broadly speaking, as rates keep going up, given that a lot of the emerging markets do have dollar debt, that gets more expensive and there could be some worries there. But I think, as far as equities are concerned, China is now 40-50% of the emerging market index. So that is the main driver for emerging markets, broadly speaking.
Manish, I want to throw in the London bias at this point. UK equities have fared rather well. They've been relatively resilient given the concerns about central bank hikes and also, of course, the geopolitics. Do you expect that trend to continue for UK equities?
So, again, so UK equities, if you look at sort of the broader FTSE indices and things like that, I think we have to be careful because they are actually not that geared towards the local domestic economy. And, if you look at central banks, in terms of how aggressive banks are around the world, there is a Fed, which is most aggressive, followed by the BOE and then perhaps the ECB and then Japan. But the fact of the matter is that the UK companies are much more globally exposed. And in particular, they have a lot of exposure to materials and energy sector. So I think that is probably why they have fared well. So as you know, just given where oil and energy prices are, the energy sector has been doing okay.
All right.
So
all right, Manish, we have to leave it there. Thanks for taking a quick trip around the world with us, Manish Deshpande of Barclays. Appreciate your time. Still ahead, it's been a wild ride for ETFs this week. We're going to take a look at how the Ukraine crisis is hitting fund flows next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. Consumer spending in the U.S. rose by more than expected last month. Purchases of goods and services were up 1.5% adjusted for inflation. That highlights the resilience of American demand despite a surge in coronavirus cases and rising prices. Morgan Stanley has disclosed that U.S. regulators and prosecutors are investigating various aspects of its block trading business. A regulatory filing admitted that the bank itself is under scrutiny. Authorities are digging into how bankers and money managers carry out stock transactions big enough to move prices. And the owner of British Airways is joining other European airlines in predicting a travel rebound. IAG expects to turn profitable this spring. The company says bookings are now running at 85% of pre-pandemic levels. IAG also owns Spain's Iberia and Aer Lingus of Ireland. And that is your latest business flash. Kaylee?
Ritika, thank you. Well, this won't be news to anyone, but it has been a volatile week in the market since Russia's invasion of Ukraine has spooked investors, led to some very wonky, volatile intraday price action. Here to wrap up how it's played out in the world of ETFs is Bloomberg's Katie Greifeld. Katie, a lot of action has happened this week when it comes to the ETF realm. What has caught your eye?
I'm going to take us straight to the ARK Innovation ETF, ticker ARK-K. It's Cathie Wood's biggest fund. If you look over the two-day chart, you can really see it showcases that huge rebound we saw yesterday. It's fading a little bit this morning, but this ETF still up 7% over the past 2 days. But if you zoom out, as you know, Kelly, it's a much different picture. Looking over the past year, it's all the names you would expect to see as we deal with global central bank tightening and now, of course, Russia's invasion of Ukraine. You have KWEB, that's Chinese tech, followed by MSCI and VanEck, Russian ETFs, and finally ARK-K. Those are some of your biggest losers over the past year, even with the bit of a rebound that we're seeing, at least in ARK-K.
Yeah, and Katie, there's been some major moves in Chinese companies, Chinese tech companies listed in Hong Kong. We've seen losses of up to 4%. It's been a little bit more stable today. There's continued concerns about the regulatory environment there, and then you have the geopolitics and rates and everything else that flows into it. What is the read across to the rest of the tech space in terms of the fund flows?
Well, at least when it comes to U.S. tech, it looks like there's some bottom fishing going on. I mean, you saw that obviously in the price action alone yesterday, but you can also see that in the flows. And I want to look at QQQ, that tracks the NASDAQ 100. It's the biggest fund that does so. If you look on a weekly basis, it's actually taken in about $3.6 billion so far this week, which is the biggest total so far this year. As you can see, it's really seen some outflows weekly so far this year, but it looks like people are willing to maybe try and call the bottom.
Katie, we were just talking with Manish Deshpande of Barclays about how he is hedging through options. How are people hedging through ETFs?
This is the really fascinating thing. So we are seeing a little bit of, a relief rally of some sort in the market, but it doesn't seem that there's a ton of conviction behind it, because if you look at SPY, for example, if you look at QQQ, the short interest on those funds, it's close to the highest level in about a year. And if you look at the corporate credit space, if you look at IG funds and high yield funds, put open interest is at an all-time high. So people are willing to step into the market here, maybe try to call the bottom, but there's definitely a lot of caution.
Katie, what are these safe haven and the hedged ETFs that are causing and getting people's attention at this point? I mean, with gold above $1,900 a barrel, $1,900 an ounce, what are you seeing in terms of the safe haven ETFs?
It's hard to say. I mean, a lot of the traditional safe havens haven't worked. I mean, if you look at treasuries this week, they've been a pretty unreliable hedge. But even so, with all the inflation anxiety that we're seeing, you are seeing a lot of money flowing into TIPS tracking funds. You're also seeing a lot of money flow into senior loan tracking funds, funds that track floating rate debt and other securities, because inflation clearly top of mind.
Finally, Katie, we're talking about where investors have been flowing to, and we talked about, fleeing out of technology a little bit. Has any of it surprised you, or is this what we would expect largely in a kind of risk-off, uncertain environment?
For a while it did. I mean, the dip buying impulse, that has been one of the defining characteristics of markets over the past few years. So the fact that we weren't seeing that really year to date up until this point was pretty surprising. But now to look at the screen and see money coming back into QQQ, this feels a little bit more like what we're used to. People trying to time the market a little bit and get in and catch that knife.
Okay, Bloomberg's Katie Greifield with the latest on those fund flows into and out of ETFs. Some lines crossing the terminal right now. Just to update you, about an hour and a half ago, we heard that Vladimir Putin was willing, according to the Russian state news agency, to meet for talks in Minsk. Now we're hearing from a spokesperson from the Kremlin saying that, in fact, Ukraine has not replied to further Russian talks offer. That is the line, that Ukraine has rejected the Minsk talks and that they wanted a meeting in Warsaw, which of course the capital of Poland. This, according to a spokesperson from the Kremlin. So this line coming, Ukraine has rejected the Minsk talks, again, according to the Kremlin.
Yeah, and of course...
Okay, coming up.
Sorry, Tom,
Katie,
I was just going to say, of course, we had heard from Sergei Lavrov, the Russian foreign minister, earlier, saying that any talks with Ukraine would be contingent upon Ukrainian surrender. And if I wonder how that is factoring into the Ukraine government's decision here not to talk with Moscow, Tom.
And so far, Zelensky's made it very clear, of course, the president of Ukraine, that he and the military will continue to fight on, at least at this point. Okay, coming up, the global economy hasn't even recovered yet from the pandemic shock, and now it faces another one. We will discuss next. This is Bloomberg.
About that all day yesterday.
It's been an hour since the start of U.S. trading. Bloomberg's Kriti Gupta is tracking the moves. And Kriti, the Thursday session was wild. How is Friday shaping up?
Yeah, well, it's been choppy, really choppy. It's only been an hour, but still extremely choppy because we started off in the green. We dropped into the red once again, just kind of pairing those initial gains that we saw. The futures actually bumping up on headlines that Russia might be into some negotiations. And then you saw this kind of reversal in the market again. The S&P 500 now up just shy of 1%. What's interesting here is kind of this tug of war between what's going on with the geopolitical risk as well as dealing with some of that just basic technicals. If you have a massive sell-off yesterday, that volatility naturally means that you're going to see a bounce back today, and that's what you've seen in the S&P 500. A similar story for the NASDAQ 100, those tech-heavy stocks, really where a lot of that volatility is really kind of focused in and concentrated on. The European stocks, though, up 3%. This is significant because remember, yesterday in the sell-off, they were the ones that were getting hit the most. Today, they are actually up the most compared to around the world, not just in the United States, but Europe and even against Asia. Europe right now really outperforming. Once again, that is going to be a natural reaction when you see simply the sell-off that we saw yesterday. You are also seeing a tiny bump up here in yields, just up 1 basis point on the 10-year. This probably following the PCE report that actually came up higher than estimates. We'll get to that in a little bit. Let's talk about stocks, though, because this is really the story. The bear market, especially when we're getting to the NASDAQ. Check this out. It's already trading pretty low. Remember, yesterday we got down to a 22% drop from the peak to the trough. Now you're seeing it down about 15%, but you are still seeing a lot of pain, like I said, isolated in those tech stocks. But that geopolitical risk, that inflationary risk, it's not the only force at play. Earnings are as well. Let's just walk through some of the big movers this morning. I'm going to start off here with Square, formerly known as Square, now known as Block. SQ is the ticker. This is, of course, Jack Dorsey's company, up a whopping 22%. They came out with some pretty strong earnings. Jack Dorsey laying out the bull case for 2022, how he wants the company to move forward. You can really see investors responding pretty positively to that move. You also have a similar story in Etsy, some roaring sales when it came back to simply how much of that e-commerce growth over the last 2 years they were able to hold on to. Once again, some strong commentary from analysts and investors smiling on that stock as well. 9% gain there. To the downside, though, Foot Locker saying that some of its business with Nike is shrinking. They also missed on their guidance, a lower guidance for the full year when it comes to those 2022 sales. So you can see really getting punished by a big amount, 33%. And ending here on Zscaler, this is a cybersecurity company beating earnings, but not beating by a high enough margin. That's going to be a major theme this earnings season, where you have them really either punished or really rewarded. And that volatility, I think, is pretty evident when it comes to these stock moves.
Kriti Gupta, thank you for running us through those market moves and some of the individual corporate stories as well. Now, some sobering numbers today on rising prices in the US. They just continue. The Federal Reserve's favorite inflation gauge had the largest annual gain since 1982. With us now, Bloomberg's international economics and policy correspondent, Michael McKee. Of course, Michael, take us through the top line numbers then. What stood out for you?
Well, obviously, the top line numbers stand out to everybody because they were stronger not only than last month, but stronger than expected. And as you put it, they are the highest since Margaret Thatcher was prime minister in the UK and Ronald Reagan was running the United States. 6.1% for the headline PCE number and 5.2% for the core, significantly higher than we were just a couple of months ago. And that has raised questions about whether the Fed should do 50 basis points or 25 basis points. Nobody at the Fed saying they're going to not raise rates in March because of the Russian invasion. But now you've got Governor Christopher Waller pushing back on those who say 25. He said last night if the economy continues to come in hot, including the PCE, he'd be in favor of 50. His former boss, St. Louis Fed President Jim Bullard, and Governor Mickey Bowman also interested in 50. So that's to be settled as we get more data between now and the 16th. The data probably aren't going to look good. Take a look at this chart here. It shows you where gasoline prices are. Take a look up in the upper left-hand corner. This is the last 5 years of gasoline prices at this time of year, and you can see how much higher they are right now. And if prices of oil stay this high, we're going to see some real moves in gasoline that will affect people and the economy and put pressure on the Fed. The one thing that is in the market's favor, however, is that oil prices seem to be coming down because the US, UK, and EU have exempted oil from Russian sanctions. And that has the markets believing 25 is probably the best case. So we now see in the Fed funds futures market that they're pricing in about 1.2 moves. So that's below the idea of 2 at this point. So just 25 basis points is what Wall Street is expecting at the moment, even though we're getting these high inflation readings.
All right, a great setup. Bloomberg's Michael McKee, thank you so much. Now let's get more on the headwinds for the global economy. Nick Benenbrook, Wells Fargo Corporate and Investment Bank International Economist, joining us now. So Nick, let's just pick it up right there. You have potential exacerbated inflationary pressures on the one hand. You have concerns about the growth implications of a war in Eastern Europe on the other. What's the central bank to do?
Well, it is a dilemma for central banks, but I think for a lot of central banks, they're still going to be focused on inflation. It's probably, I mean, even if you look back at the last European Central Bank meeting, for example, they had a slow growth environment related to the Omicron variant, but very high inflation, and they sounded a little hawkish. So at the end of the day, if they're sort of being pulled between these two competing forces, I do think that it's going to be the inflation concerns that will probably be the most influential driver of their policy element.
Nick, are we looking potentially at a stagflationary environment here in Europe?
No, I don't think so. I mean, it depends how you define stagflation. And personally, I define stagflation as, several years of very high inflation and little growth, 3, 4, 5 years. So I still believe that, probably by this time next year, we'll have inflation, very close to sort of 2 to 3%. So that's reasonable. It's not at target, but it's reasonable. And I suspect we'll have growth recovering as well. So I don't think we're in a permanently low growth, high inflation environment, in my opinion.
How does the geopolitical situation change that calculus for you, Nick, if at all?
It's certainly I'm not a geopolitical expert, and anything, a lot of different paths are possible there. What I would say is if the situation remains similar to how it is today, and again, I'm not making any predictions there, I suspect that, if we don't see a further escalation in the military tensions between the Ukraine and Russia, I suspect that we will see these central banks continue with their rate hike path. And actually, I do believe that the impact on the Western economies, even the European economies, will be moderate, but I don't think it'll be severe in terms of, the downside hits to growth in countries like Germany, France, United Kingdom.
Nick, the data out of the US today seems to suggest that the consumer remains relatively healthy stateside. What is the resilience of the consumer here in Europe, particularly as real wages remain in negative territory?
Yeah, I think the consumer's looking okay across Europe. Certainly the high inflation is an issue in the case of the United Kingdom, and with those electricity bills expected to rise in April, for example. But we had a couple of interesting little tidbits out of some of the GDP figures that came out of France and Germany today, which were showing increases in household disposable incomes. Now, sure, as you point out, a lot of that was sort of eroded by inflation, but at least we're seeing like nominal incomes growing, we're seeing wages growing, and we're at least seeing real incomes hold steady. And of course, we still accumulated savings from the pandemic. So I think overall, even with inflation weighing on purchasing power, the fact that you are getting income growth and the fact that you have these very high, historically high savings rates, there's still, I think, enough firepower there for the consumer to support recovery.
Nick, you mentioned rising wages there, and I'm wondering what your expectations for wage growth are and whether that includes a spiral.
Depends where you're looking at and sort of which countries you're focusing on. In the case of the United Kingdom, I think, certainly we've seen some relatively high wage numbers there, and so I suspect the Bank of England has been more proactive and probably will continue to be more proactive in terms of raising interest rates. In terms of a spiral, I don't know if we're going to, go from sort of 4 or 5% wage growth and go to 7 or 10. I doubt that we'll see that, but it's already fairly elevated. And of course, I think we had some comments from the Bank of England encouraging individuals to take, lesser wages, which didn't go across particularly well.
Yeah, you could say that.
So the wage pressures seem to be relatively modest at this point, so I suspect that we're not going to have significant wage spiral pressures across the Eurozone.
Nick, we're going to be speaking to the European Commissioner for the Economy shortly, and we'll be asking him about the fiscal impulse in Europe. Is there any dry powder at play within the European Commission to help support the economy, given the geopolitics of the moment?
Yeah, that's a good question, and the way I would phrase that is, I don't know if there's like dry powder per se. There is, of course, the EU Recovery Fund and all the grants that are coming out of that, and those disbursements are starting to roll out. I think what I would say, which is helpful at this particular point in time, is the fiscal grants and the fiscal stimulus that's coming through is at least, I would argue it's relatively neutral. It's at least sort of supporting or cushioning what's happening with the economy. And that's a little bit of a contrast to what we're seeing in some other countries. Like for here in the United States, for example, we obviously had a very significant fiscal stimulus during the pandemic or the heights of the pandemic. And now a lot of that's being withdrawn. So that's a bit of a headwind. In the case of Europe, I don't necessarily think there are any tailwinds in terms of additional stimulus, but I don't believe that there's much in the way of headwinds in terms of that fiscal stimulus being withdrawn at this particular point in time.
Nick, we consistently hear from central banks that they are going to be focused on the data. What data points in particular carry the most weight to you right now?
Again, looking at it from a sort of a European perspective, certainly the inflation numbers are extremely important. And, in the case of the Eurozone and even in the case of the UK, but in the Eurozone, for example, the base effects don't look good. So we're almost certainly going to see further increases in headline inflation to maybe 5.5% across the Eurozone, and even core inflation, maybe near 3% as well. So I'd definitely be looking for upside and surprises on inflation as being critical. And the other thing that I'm watching extremely closely, and both of these numbers were encouraging for February, are the purchasing managers, PMI surveys, purchasing managers indices. They both picked up fairly strongly in the month of February, showing a recovery from the sort of Omicron variant. So it'll be interesting to see to what extent they would be, depressed by some of the latest geopolitical concerns. But, if we continue to see improvements in those PMI surveys, then, with the elevated inflation that we have, it's probably going to not be enough for these central banks to be acting over the course of this year.
Okay. The importance of continuing to watch the PMI data and not seeing the central banks derailed by the geopolitics, at least not at this point. Nick Benenbrook, thank you, of Wells Fargo, for those insights. Okay, coming up, there is one word for the commodities markets. The last couple of days, volatile, that is to say the least. In a moment, we're going to talk with Doug King, CEO of RCMA Capital, about the movements within the commodity markets, where he sees pricing and supply chain constraints from here. This is Bloomberg.
Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. President Biden has made his decision on who will replace Justice Stephen Breyer on the Supreme Court. Bloomberg has learned it's federal appeals judge Ketanji Brown Jackson. It's confirmed Jackson will be the first black woman to serve on the Supreme Court. The president is expected to make the announcement this afternoon. And consumer confidence in the UK fell this month by the most in almost 2 years. That's when coronavirus lockdown restrictions were first announced. GfK's monthly index is closely followed by the Bank of England and the Treasury. It says households are worried about rising inflation and taxes. And a chemical tanker was hit by shelling in the Black Sea near Ukraine today. The Millennial Spirit, a ship flying the flag of Moldova, burst into flames. 10 sailors jumped overboard and were rescued by Ukrainian authorities. The shell came a day after a ship chartered by Cargill was hit by shell fire in the Black Sea. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you. Well, this goes with the story that Ritika just read about the disruptions we're seeing to some chartered ships in the Black Sea. The invasion of Ukraine has made supply chain challenges a lot worse. From chemicals to oil to wheat, about the only thing that buyers and sellers can count on is uncertainty. We're joined now by Doug King, CEO of RCMA Capital. He runs the Merchant Commodity Fund. Doug, just give me your view of what we have seen play out over the last 48 hours.
Well, quite incredible roller coaster. Started early in the morning, and obviously in the invasion, everybody super uncertain of what that meant, but took the risk premium and thought what was going to happen sanction-wise, and we waited pretty much throughout the day to see what the reaction would be. And later on, we got the reaction from the Western governments and the President of the United States, and it looked like energy was not going to be at all affected. And to put that into context, you can understand why. There's 8 million barrels a day of crude and products coming out of the FSU. That's nearly as much as Saudi Arabia produces. So to really impact that would have been a ginormous jolt to the world oil markets. And similar on gas, 30% of the gas from Russia heads into Europe. And if that had been stopped or curtailed or sanctioned, we just would have gone up astronomically. So I guess in a way we got what we got, and the market has reacted with that and made a call that things are not going to be quite as bad as anybody thought, and the markets are pretty much where they started yesterday morning.
Yeah, Doug, we're looking at Brent now, $97 a barrel, $91 for WTI. We were above $105 at one point for Brent yesterday. What are we seeing in terms of premiums, in terms of prices? Do you have any clarity, you and the team, about where prices go from here? How linked is it to the moves of Vladimir Putin in and around Ukraine?
I don't think, I mean, obviously there's been a lot of uncertainty geopolitics-wise for quite a time. The build-up on the board has been there for everybody to see. I think the issue is more that oil supplies are extremely scarce. The market is extremely tight. It's trading huge, what we call inverses, where the price is much stronger now than it is in the future, and cash crude prices are extremely strong. What just happened, the market is extremely tight, and OPEC struggle every month or every 3 months when they meet to add production to the story.
Yeah, Doug,
so,
on that
I have a bullish view.
On that point, given how tight the markets are, give us your read on what the spare capacity is like. Can we get these things from elsewhere should there be disruptions?
If there's a major disruption of oil, if oil is sanctioned and can't be sold, if you see what happened in Iran, there were sanctions and some of the production in Iran has been shut in. Some has been used, or a lot of it's used domestically, and some is still finding its way out there. If that happened in the FSU and some of the oil was not able to be moved, it would probably have to be shut in and obviously therefore not produced. So obviously it'd be very, very bullish. There is very, very limited spare capacity in the world. I mean, really not a lot at all. You can probably get a bit of shale growth at these prices. OPEC will talk that they can produce more, but we don't see it. Every time they increase production, they actually don't. So, this market is in a very precarious, strong position, with probably some global demand coming back when we come out of this pandemic finally and get some flights back in the air, because jet fuel has always been sort of lagging. The demand for jet fuel has disappointed for 2 years for obvious reasons. So yeah. I have a bullish view on oil.
Doug, I want to move from oil to the soft commodity space because I know you're involved in that as well. Where are the pain points around supply chains when it comes to soft commodities?
massive exporter, obviously, Ukraine, wheat particularly. It's around about 25% of global wheat trade. So we saw yesterday the wheat market up as people thought they might have to find alternatives. We've seen it today move right back down again for all the reasons we've just discussed. A major one that I think is not really being seen yet is the vegetable oil space. So they are the biggest exporter of sun oil in the world. 60% of sun oil exports are coming out of Ukraine. Vegetable oil markets are extremely tight as oil and food clash to try and balance the decarbonisation agenda. And so we may see, and I'm already hearing anecdotally, that some of the processing facilities have shut, some of the ports not loading. So it's more like a disruption now where people make the supplies rather than we haven't actually got.
Doug, is there anywhere within the commodities that could be affected that the geopolitical risk premium is mispriced, whether over or under?
Geopolitical risk is always hard to assess. We live with it all the time for the reasons that we've just seen in the last 48 hours. I think it's broader than this. I think that, I've been trading commodities an awful long time. There's structural supply side issues as we go into this decarbonisation and come out of COVID. And I just think that what's going to happen is that prices rise. You normally get a response. People produce more. That's why commodities are always so cyclical. But actually, this time around, I don't really see it. I think if oil prices go up to 110, 120, I don't think many people are going to do very much and the shale. And so I think that will be allowed to run unchecked and you won't get that supply response. And I could give you that argument across a multitude of commodities. And that's why this is a supply side structural bull market that's just getting going. Inflation is with us. It's core. It's not transitory. And that's where we sit in our fund and how we invest currently in the marketplace.
Okay, a structural bull market that is just getting started. Doug King, thank you for those insights, CEO of RCMA Capital. And back to the geopolitics. Lines crossing then from US defense officials who've been briefing reporters on the military attack, of course, in Ukraine and around Kiev by the forces of Russia and Vladimir Putin, saying that several hundred Americans have crossed into Poland. But on the military picture, US officials are saying that Russia has used about a third of its forces arranged against Ukraine, that Russia does not have air dominance over Ukraine so far. That we know is a key aim of the Russian military. The US saying they do not have air dominance over Ukraine so far, and also saying that Ukraine's military's command and control center remains intact. So an update there from US defense officials on the ground in terms of what is happening on the ground in Ukraine. Plenty more coming up. Stay with us. We'll keep you across all of these headlines. This is Bloomberg.
Geopolitics still front and center for these markets, but the turnaround of Thursday leading to continued gains on Friday. The S&P 500 right now at session highs up more than 1%. The bond market is steady. Oil is lower. WTI crude trading at a 91 handle right now, and Bitcoin benefiting from the risk-on sentiment. It turned around with tech yesterday, saw an update. It's seeing another update to end the week here, up 2.5% on Bitcoin, trading at the 39,000 level top.
Yeah, no sanctions yet on the energy sector of Russia, and SWIFT has not been cut off for Russia as well. That's benefiting the banks and, of course, the energy space as well. Here in Europe, you're seeing gains of more than 3%, so almost making up for the losses that we saw yesterday. Still, you're likely to close out the week just a smidge lower, but given the geopolitics, it is Friday, the 25th of February. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
The dramatic market moves continue. The European stocks gaining more than 3% as we head towards the close. Two things that didn't happen, and this has given investors some reassurance. One is that Russia was not cut off from the SWIFT system. The other is that the energy sector was not targeted by sanctions. That is yet. That has not happened yet, but nonetheless there is some relief in the markets. You're seeing that reflected in Russia as well. We've had lines crossing. There were going to be talks in Minsk. Now there aren't going to be talks. We continue to keep across those geopolitical lines as the military action in and around Kiev continues, and Ukraine, of course, remains under invasion from Russia. In terms of how things are playing out then, gains of more than 3%, as said, across the benchmark. In Russia, gains of 20% on the equities there after very heavy losses yesterday of around 25%. That was the close yesterday over in Russia. Brent crude, it went above 105 on Brent yesterday, now down to $97 a barrel, though we speak to the strategists and the oil experts. They say, look, in terms of what's happening with the supply-demand dynamics, there is only upside for Brent, but currently at 97. That is the shape of play then across these European markets. And we're going to look as well at some of the individual sectors and how they've broken down. Certainly banks and energy doing very strongly indeed, Kaylee.
Well, and that has been the trade of 2022 so far when you look at it on a sector level, though energy, of course, is one of the stories most in focus given these geopolitical tensions. On this Friday, we are seeing a continuation of the gains we saw later in the day yesterday. It really was quite an incredible day of trading on Thursday. At the moment, the S&P 500 up a little more than 1 percentage point. All is calm in the bond market. We are literally unchanged on the 10-year yield. 196.34 is where we trade. You aren't seeing that kind of bid for safety playing out today as it did in the earlier part of yesterday. As with Brent crude, WTI crude futures also lower, down the better part of 1 percentage point. We are just below $92 a barrel. And I wanted to point to Bitcoin as well, trading in tandem with other risk assets, specifically with technology, as we saw playing out yesterday as well. Bitcoin is higher by the better part of 3%. We're trading at $39,400. This asset holding up quite well, even in face of all of the geopolitical concerns still outstanding for these markets, Tom.
And it is day 2 since Russia's invasion of Ukraine. Russia says it is willing to hold talks. The Kremlin says Ukraine hasn't replied to Russia's offer to talk. Joining us on the phone is Bloomberg's Maria Tadeo. Maria, just get us up to speed on what we've been hearing and what your take is of the lines crossing from Russia when it comes to these proposed talks. How serious do you think they are?
Well, Tom, what you need to think here is that the government of Zelensky has been asking for weeks now to speak directly with Vladimir Putin. The Russians do not want to do this. They want to send a message that Zelensky is a second-tier politician, that he does not get to talk to the president of the Russian Federation. Now, if you look at this original pitch that we heard today, is a meeting was supposed to take place in Minsk. This is in Belarus. It is very difficult to see a Ukrainian delegation taking such a risk. Minsk, as you know, is in Belarus. Belarus has a leader called Alexander Lukashenko, who is clearly, and by all means now, a puppet of Vladimir Putin. He's the only person right now that supports this regime of Lukashenko. This is not a safe place for a Ukrainian delegation to talk about the way forward. What's also clear is that the Russians say they want full capitulation. They want the Zelensky government completely out. Vladimir Putin just went on TV and said, this is a government of drug addicts and neo-Nazis. That's why we should take them out of office. The government of Zelensky, they say, we stay put. We're not going to leave. If there's a ceasefire, that would be welcome for all of us. But if the Russians continue to fight, Ukraine is going to continue to fight. And today he says anyone that can operate a weapon, that knows how to operate a weapon, should be fighting to defend the capital city. And by the way, we hear that the advance from the Russians into Kyiv is not as quick as they had anticipated. A lot of this, as we know, is because there has been really a lot of resistance fighting overnight.
Yeah, and we understand from U.S. officials that Ukraine's military command and control has remained intact, that Russia does not yet have air dominance. We just had those headlines crossing in the last 20 minutes or so. Thank you so much to Bloomberg's Maria Tadeo for fantastic reporting over the last few days. Now let's get more on these geopolitical risks. We welcome Alexander Smotrov, a strategic advisory firm, Global Counsel. He leads the practice for Central and Eastern Europe, Russia, and Eurasia. Alexander, thank you so much for being here. Clearly, the sanctions that the West has put on the table thus far have had no impact. SWIFT doesn't seem to be on the table. Maybe personal sanctions against Vladimir Putin and Lavrov are going to take shape. Does any of it actually make a difference at this point?
Hi. You know what? So the personal sanctions has not produced that much of effect as of now, I would say, because they are more symbolic and kind of a way to show that the whole Russian elite is being kept on their toes, and maybe further measures when they come, especially from the UK or the jurisdictions where these people might have some tangible assets, might prompt them to act in a way. But the sectoral sanctions are historically more effective, and we've seen this throughout the last 8 years, since 2014, when they were first introduced on the Russian energy and financial sectors, and further down the line on some other areas. So, and already there are some effects actually on the ground in Russia, as far as we can observe, with some payments not being processed by the banks, or, for example, where the Russian replacement systems were in place, they work, while, for example, payments which are processed internationally, like through Apple Pay and Google Pay, are not being that stable, and this is probably what
Alexander,
what might be there.
Alexander, that takes me on to my next question, which is around SWIFT. There's been a lot of debate here in Europe about whether or not to cut Russia off from the SWIFT payment system. Certainly the UK has been pushing it. France and Italy are against it. To what extent is Russia, and have they been able to build out a resiliency around that prospect, or would it be severely damaging to the financial sector there?
So it looks like that the disconnection from SWIFT could obviously impact Russia, but not as dramatically as it could impact the Western banks themselves, because Russia has devised its own system for this interbank messaging system, and they might activate it. They already tested it, did some exercises and so on. So it might be activated and used in Russia, with the West having zero visibility.